Hello beautiful beings, welcome to our beta version, and in today's video we are going to talk about part 2 of our investment jargons that we need to know. As I said in the previous video, many of us goals when it comes to our personal finances is actually financial freedom. However, we cannot save our way to financial freedom. We need to invest some of our earnings. So when we do our budget, like I have said in a previous video, we are supposed to have money going to our savings and money going to our investments. And no matter how small that amount is, it makes a big difference. Knowing that finances are not taught in schools, it's our responsibility to make sure that we self-educate. We learn in whichever platforms are the easiest for us to learn from, so that we are able to grasp what we need to know, and then we are able to implement so that we improve our financial standing and we eventually are able to reach our financial goals. At number 21, we have volatility. Volatility is the amount and frequency with which our investments fluctuate in value. When our investments are going up and down, that is what it's called volatility. At number 22, we have growth stock. And growth stocks are companies that are experiencing rapid growth. And a lot of investors want to, benefit from that growth. So those are the growth stocks. An investor does their research and they look at that stock and do all the fundamental analysis to ensure that that stock really has potential to grow and bring the returns that the investors are looking for. A growth stock is a typical well-known company that is experiencing rapid growth in terms of its revenue and earnings, and it usually pays little to no dividends. At number 23, we have capital gains. Capital gains is the difference between our investments, the price that we bought our investments for and the price that we are selling it for. When there is a positive difference between when you bought an investment and when you are selling, that is the capital gain. Then we have dividend yield at number 24. And dividend yield is the percentage of return earned by a fund. It could be a mutual fund, it could be an index fund. Then at number 25, we have dollar cost averaging. This is one of the things that one must have actually as part of their investment strategy, because dollar cost averaging allows you to enter the market at different price points. So when you consistently put in a certain amount in your investments and you are not putting in a lump sum amount, then you are doing what we call dollar cost averaging, and it can be beneficial for you to actually lower the price that you are buying that stock or that ETF. At number 26, we have expense ratio. Expense ratio is the difference between a fund's operating expenses for the year and the average value of its assets. At number 27, we have small cap stocks. These are stocks that have a market capitalization of less than 3 billion. So the share of the market that these companies or these stocks take up is less than 3 billion. Then we have mid cap, and mid cap refers to a market capitalization that is between 3 billion and 10 billion. At number 29, we have large cap stocks. These are stocks or companies that have a market capitalization of more than 10 billion. At number 30, we have a management fee. And a management fee is the amount that is paid by investors to a fund manager or investment advisor for their services. We have the price to earning ratio, and this is the stock price divided by its earnings per share, which indicates how much investors are paying for that company's earning power. At number 32, we have short-term investments. Short-term investments are those that are purchased for a lifetime of the investment of less than 1 year. So it's investments that are purchased with an investment life of less than a year. At number 33, we have long-term investment strategy. Now, the long-term investment strategy looks at the long-term, investing long-term. And you are not trying to look at the daily movement of your stocks or your investments. So you are in for the long haul. So as part of your strategy, you are not trying to cash out immediately. You are actually looking at making use of those investments in a long term. At number 34, we have value stock. A value stock is a stock that appears to have a low price compared to its financial performance. At number 35, we have year to date, also abbreviated as YTD, and that is when you are looking at a period between the beginning of the financial year up to the present day in terms of performance of your investment. So that includes appreciation and dividends or interest. So it's that period from the beginning of the financial year up to the present day. So that is the period that you are looking at. At number 36, we have yield. Yield is the annual percentage rate of return on capital. So it's the dividend or interest paid by the company expressed as a percentage of the current price. At number 37, we have a bond fund. And a bond fund is just a type of a mutual fund that exclusively invests in bonds. So basically it's a mutual fund that only invests in bonds. So that is a bond fund. Now, an equity fund on the other hand, which is what we have at number 38, is a mutual fund or a collective fund that invests primarily in equities. So that is your common stock and your preferred stock. At number 39, we have a Treasury Bill. And this is a negotiated short-term debt issued by the government. So, for instance, in Namibia, that will be issued by the Bank of Namibia, being our central bank. At number 40, we have a Treasury Bond. A Treasury Bond is a long-term debt obligation that is issued by the government. We have come to the end of our discussion on the 40 technical jargons that one needs to know. In the previous video, we looked at 20 of them. In this video, we also looked at 20 of them. I do hope that you have found some value in this video and you have learned something, and I'll see you in the next one.